Yo, what's up, guys? We're doing another Wise Well. Today we're doing swaps. So, you probably heard of swaps during the 2000 or the housing crisis, credit default swaps. So, what actually are swaps? Well, it's a derivative contract between two parties that exchange the cash flow or liabilities from two different financial instruments. And usually, most swaps involve a principal amount that relates to a loan or a bond. Each cash flow is one leg of the swap, and one cash flow is usually fixed while the other one is variable. The most common swap is the interest rate swaps, and swaps are not traded on typical exchanges such as, say, the New York Stock Exchange or the CME Group. And you're not going to see swaps that are traded by retail traders. It's usually between businesses or big banks, financial institutions, hedge funds, whatever you want. And so, what are some types of swaps? Well, we have interest rate swap, which is where parties exchange cash flows based on the notional principal amount of an underlying security. And the amount of principal is not actually exchanged, but the cash flows relating to the interest rate are. We have a debt swap, which involves the exchange of debt for equity, which is how companies refinance their debt. We have a total return swap. Total return from an asset is exchanged for a fixed interest rate. For an example, one party may agree to pay a fixed interest rate to the other party in return for a capital appreciation. And we also have commodity swaps, which is pretty self-explanatory. It just involves the exchange of a floating commodity price for a set involves the exchange of a floating commodity price for a set price over an agreed upon period, which usually the swaps are crude oil swaps. We also have currency swaps where you exchange interest and principal payments on debt denominated in different countries. Cash flows are based on a fixed rate and variable rate, and it takes place between two countries because you need two currencies. And then now we have credit default swaps, which is where it's an agreement between one of the parties to pay the amount of lost principal and interest of a loan to the buyer of the credit default swap if the borrower defaults on the loan. So, what an example of a swap? So, say we have company XYZ and issues 3 million 5-year bonds with a variable interest rate plus 1.3%, which is also known as the secured overnight financing rate or SOFR. Assume the SOFR is at 2.5% and XYZ is anxious about the rise in interest rates. So what they'll do is they'll find another company, we'll call them ABC here, that is willing to pay the annual rate of the SOFR plus 1.3% on a notional principal amount of $3 million over for 5 years. And ABC will essentially fund XYZ's interest payment on the bonds. And in return, XYZ is going to agree to pay ABC a fixed annual rate of 5% on a notional value of $3 million for 5 years. So how do they benefit? Basically, XYZ is going to benefit if the interest rates rise significantly over the next 5 years, and ABC will benefit if the interest rates fall, stay the same, or increase, but not as fast as it needs to in order to make a profit. So essentially, that's what swaps are. They're very much much more complex than other derivatives. But it's basically an agreement between two parties to exchange something. And swaps are not available to retail investors. It's usually big banks, hedge funds, financial institutions, businesses, whatever you want. But yeah, I hope you understand what swaps are now. In my next video, I'm not sure what I'll be talking about, to be honest, but stay tuned for it.